Hello and welcome to this morning's market briefing this Wednesday on the 7th of September. We've got lots to talk about. A top Fed official is signalling that rates will stay the same this September meeting. As well as that, we've got the leader of the global financial watchdog, FSB, that is warning G20 members that the next few months are going to be risky, or at least troubling for the global economy, with new and higher rates setting in now across the economies. And as well as that, we're seeing strong gains on the dollar following last week's job release data. And as well as that, we're seeing bonds in the US going down, and so the yields are going up. There's lots to talk about, lots happening on the charts, and there's lots to talk about coming up today on the economic calendar. But we'll get straight into it, talking about this article here to do with the top Fed official, Christopher Waller. Now, he's yesterday, signaled that the US central bank is preparing to hold the bank rate at the current level. Now, this is echoing the same sort of things that we heard from Jerome Powell in Jackson Hole last month, along with other Fed officials. And now with jobs data coming out, it's seeming that there is little need for an interest rate hike, as it's seeming more and more so that inflation will fall. That said, the jobs data has also kind of shown that the economy is resilient, and so whilst it is likely that rates will stay the same, it's likely that they'll stay at the level that they are for quite some time. And as I said, the recent jobs data has shown that demand for workers is moderating, which is hinting to why they might not need to raise rates, because it seems that employers are already starting to see the costs of higher borrowing rates with the higher interest rates. Now, this is kind of more significant with Christopher Waller saying this, due to the fact that he's more of a hawkish member, so someone that we usually expect to want higher rates. And so by him echoing the message of Jerome Powell that rates won't increase in this September's meeting, we're far more sure on the fact that they actually won't have a 0.25 increase. Now, Waller did also say that he wants a couple more months of similar data to the data we saw on Friday to do with the jobs before we can call this kind of data a trend, and decide whether this is actually the way the US economy is trending. But ultimately, with recent inflation data showing inflation's only rising at 0.2% per month, the Fed is pretty pleased with this, as it's shown that the economy and prices aren't going up exponentially. But now most market participants do believe that the Fed is already done raising rates, and 0.25% rate is the most they will ever go up, and we're more likely to see that in November, it seems, up from what we've heard from other Fed officials, including Jerome Powell. But also we have to remember that Powell did warn that if economic growth does continue, tightening may be required, so keep your eyes on the US bank rate. But that's it for that article. We can now move on to the global financial watchdog. Now, the chair of the FSB, the Financial Security Board, the financial watchdog, warned of further challenges and shocks in relation to the global economy, with high interest rates undermining economic recoveries and especially real estate. We've seen real estate issues in China, but this is kind of expected across the whole of the globe, with the UK currently experiencing somewhat of a mortgage crisis as a result of higher interest rates coming out of COVID. Now, this came in the lead up to the G20 summit in New Delhi. The leader of the FSB, Klaus Knott, is the chair of the FSB, and he essentially said that the global economic recovery is losing momentum, and the effects of the rise in interest rates in major economies are increasingly being felt. But what we have to remember when someone like this does say that is it's a trade-off for the central banks, that whilst they want to bring inflation down, they also don't want to hurt the economies. And if they want to bring down inflation, they're obviously raising rates, and so this is causing the slowing economic growth. So it's kind of a give and take scenario here, where it's likely that we will have to see some slow, deceleration in the rate of growth for us to actually see a fall in prices, so people can stop worrying about that. Now, this also comes after financial markets have been relatively stable for the past few months. I mean, we did see what the kind of fall of grace for Credit Suisse and then it being acquired by UBS. However, ultimately it has been quite a stable period considering what we're coming out from, which is a global financial shutdown following COVID, mass stimulus and record low interest rates. Along with that, now we're dealing with other external crises like the 22 Russian invasion of Ukraine. And so he's essentially saying that whilst all of this has happened, we've still had quite a strong financial period, but this may change in coming months. He also highlighted the vulnerabilities within real estate, which is one area which should be heavily monitored by any government agencies or administrations due to its vulnerability in relation to high interest rates. And now that's going back to the current issues within the UK. He also noted that the reason why we haven't really seen the issues arise from high interest rates yet is because fixed rate loans have meant that it will take longer until high interest rates are felt by borrowers. And now these are loans which are given out on like a yearly period, where before the monetary tightening took place, these were loans at a very low interest rate compared to what they would be now based on the current bank rates across the globe. And so it hasn't really been felt by a lot of borrowers because they are on those fixed rate loans. Now, he also stressed the need for tighter regulation of non-bank financial institutions, including hedge funds and insurers. But this is the usual rhetoric that we're likely to hear from someone like that. But the key thing to listen out for here is the risks to real estate coming into the next few months as sectors within markets start to really feel the brunt of high interest rates, which still haven't really been felt to their highest extent yet. So that's something to keep your eye on, kind of worry you at night, but I'm sure it will be all right. Now, coming to the third article, we've got Treasury yields and the gains on the dollar today to talk about. Now, it was an interesting day in the markets yesterday on Tuesday. With the dollar climbing to a 6-month high on Tuesday, with government bonds coming under pressure, rising by 0.6%. Now, this is kind of an interesting scenario because we spoke about, and we have been speaking about, how the dollar might react to this job data, and it seems that the dollar's taking a positive effect as people are seeing that the fact that the US economy is still so resilient, it's likely that rates will be high at the same levels that they are, which is high, for a longer period of time. And so this has gains on the dollar, obviously, as people move their money in to gain that higher interest rate. And as I said, this came as investors weighed the future path of monetary policy. Now, the 10-year bond yield rose 0.1 percentage points, whilst the 2-year more sensitive bond yield raised 0.09% as the bond prices fell. Now, jobs data has shown signs of persistent economic resilience, hinting to investors that the US rates need to stay higher for longer, and this is what I spoke about. And it also links back to what Christopher Waller has said in relation to the recent data, which has affirmed the idea of there being a soft landing of the economy, which will mean that rates will stay higher for longer. And as I said, most people are now citing the results of yesterday's market performance on the US jobs data, which came out on Friday to do with non-farm payrolls and unemployment figures. Now, going to China, which we've been speaking about quite a bit over the past few days, low service sector data in China also hints to a global economic slowdown. Now, I know yesterday we spoke about the gains in the property sector of China and kind of a more optimistic look to do with the stock market, with indices rising after promises of subsidies to property markets. However, today it wasn't so good. The gains made by Chinese indices following the government support announcement reversed by with the CSI 300 dropping 0.7%, and that's the flagship Chinese index. Now, this obviously came with the low service sector data in China, which came out yesterday, as I said, which is hinting at the low economic at the global economic slowdown. Traders were also concerned yesterday, were added to by the fact that oil prices jumped after Saudi Arabia announced it would extend its oil supply cut of 1 million barrels a day until the end of December, as a result creating almost a supply shock within the oil markets and causing a rise on oil's price. We'll come to that in a bit. It looks like there's some opportunities possibly opening up on US oil. I know I've spoken about that over the past few days, but it is seeming like a good product to trade right now. The S&P 500 also closed down 0.4% yesterday, down 0.4%, with the Nasdaq also closing 0.1% down. And so overall, it was quite a negative day in terms of US indices as well as Chinese indices, but positive for oil and also positive for the dollar. But that's all for the articles. It's now time to have a look at the charts, and so we can come to that right now. Actually, I'll keep on this. Sorry about that. So the first thing to look at is the US 30, the Dow Jones. Now, I spoke about US indexes not having the best day yesterday. But what does that mean for us? Well, it opens up opportunities. We know that at some point the US market will reopen, rates will fall, and so it's all about trying to get the best positions at what times. And following the US jobs data and the understanding that US interest rates are likely to stay higher for longer, we understand that the market is going to retrace. Something like US stocks would retrace after that sort of data. So if we're looking to get a buy from that position, it's important to use tools like the Fibonacci retracement tool, where we can put on these levels and kind of look for areas of liquidity in line with the Fibonacci areas. And in terms of looking to the buy side of the US indexes, in terms of the Dow Jones, it seems like areas like the 6180 area has high areas of liquidity with previous areas of levels of accumulation prior, as well as the 50% mark with other areas of liquidity around that. So those are the two levels that I'd be looking at. Coming to the US 500, the S&P 500, we've also got a similar scenario of kind of a retracement taking place off the back of that US jobs data and the rhetoric coming out of the Fed. And so I'd be looking for buys maybe from this 61.8 area where it looks like most liquidity is, or even the 38.2 area. But you always have to be careful in these sort of scenarios that it doesn't retrace too far and kind of take out your stop loss if you're getting in areas like 38.2. Moving out of that, we can now have a look at the charts in relation to the dollar. Now, as I said, and I've spoken about recently, this was kind of the prior high that has been set for the dollar in recent weeks. And yesterday, it was able to break above that level, making new highs. And so for us as traders, it's best to try and look for an opportunity now on a retracement as it kind of runs out of steam and looks to gain liquidity again. And I've seen this on both the Euro US dollar pair as well as USD JPY, which we'll come to now. Now, we spoke about this area of liquidity below, which was set by the lowest low in May 2023. And now Euro USD is broken below following dollar gains, broken below this recent low, an area of liquidity. We should be looking to either gain buys around this area of liquidity at the 1.067 level, or even gain extra shorts at this area of prior support around the 1.077 area, which is a good area of liquidity, as we've seen here, basically 3 times punching down for support. And as we know, support can often turn to resistance. So if you're looking for shorts down to this area, that would be the area to look at. Likewise, on the USD JPY pair, we saw household spending data come out yesterday to show that inflation is unlikely on the yen. However, despite that, dollar signs were stronger than the yen, and so we've seen dollar yen break above its prior high here at the 147.38 mark, and so now it's broken above there, but obviously it will run out of steam at some point, and it's about us looking for areas where price might retrace to get in buys. And this is the area that I've had highlighted for a while because it looks like a strong area of resistance and now possibly for support, where there's been liquidity kind of snatched before by buyers and sellers. And so if I was getting in a trade to the upside here, I'd probably be looking around that mark, trading off the 38.2% fib if I could. And so that would be the area that I would have my eyes on right now, that 38.2% mark, where we might see a break. As we've seen here, it's broken the resistance. It might hook back and then go again for higher highs. So that's where I'd keep my eye on if you're looking for a buy within the market. Now, what happens when dollar gains? Gold usually falls. So coming to gold here, we can see that gold's kind of broken below this trend line and is now dipping into this area of prior liquidity. And if we're thinking about the dollar possibly retracing after yesterday's highs, we should also probably be thinking about gaining buys on gold, and it's currently sitting at this 38.2% fib with a strong area of support and liquidity here around the 1920 area. And so if you're looking for buys, this is also a strong area, but keep in mind that it's now just broken below a trend line. So it's likely that either it's going to hook back and then just continue down, or just drop down from the trend line and continue a rally down. And so keep your eyes on gold, certainly. And finally, in relation to the markets, we've got US oil, which I spoke about before. And these areas of liquidity alongside the Fibonacci table is lining up nicely. So we made new highs yesterday on US oil after the Saudis kind of confirmed that they were cutting oil supply until December, or at least somewhat cutting the oil supply until December. And so if I was looking for areas to buy if this now retraces, because it's still kind of overbought, as we can see on the RSI here, we're seeing this RSI divergence, so it's very likely that it's going to retrace now because it's becoming overbought. And so if I was looking for areas that I could then get on with this rally, it would be the 38.2% area and the 50% area, where there's two really strong areas of liquidity. But ultimately, just by how strong US oil is looking right now, I'd probably get in at a closer level like 38.2. But that's all for the markets. Now let's come to what's happening today on the economic calendar. So what's happening? Well, firstly, we've got sorry about this. I can list it off because I've got it on my my briefing. Yeah, there we are. So what's coming with today? The first thing that's we can expect to see today is the Aussie GDP growth rate, as we can see here, and so that'll be important to understand if you're making any trades on any AU pairs. We've also got UK construction data coming out to see whether it's expanding or contracting. We've also got Eurozone retail sales, which always kind of gives us a hint to what inflation is going to be like, because obviously retail sales links into consumption, which is a component of aggregate demand, which plays into inflation. So keep your eye on Eurozone retail sales. We've also got the German 10-year bond auction, as well as that the US 30-year mortgage rate, which is interesting to see after we spoke about the kind of US housing crisis, which is almost being hinted to by the FSB. As well as that, we've got the Canadian bank balance of trade, along with the US balance of trade and US business output data. So remember, with any US balance of trade or Canadian balance of trade, that really does play into any forex pairs and how they'll become priced in. We've also got the Canadian bank rate decisions that will be important for anyone trading any, Canadian pairs or USD, Canadian. As well as that, we've got US services data. We saw yesterday, we saw a lot of negative European services data, so a contraction in relation to European services output. So it'll be interesting to see how the US services respond, because it's expected that there's a decrease in the level of expansion, but still an expansion in relation to US services. So that'll be important to understand whether we're going to see a hard or a soft landing within the US economy, or just a continued level of growth. And as well as that, we've also got the Fed Collins speech and the Fed Logan speech. So a lot happening today on the economic calendar, lots of opportunities following rallies and declines within the markets. But yeah, have a great trading day, guys. Enjoy the rest of your Wednesday, and yeah, have a great day. Bye.